time. Man, the Secretwars series is some work, and it feels good to grind it out, go through it, and that's the best way to learn. There's no shortcuts. There's no one tweet, and there you have the end all wisdom to trading. That's good for followers, but you gotta go through it. Gotta go through the whatever system, whatever framework pleases you, and you have to iron it out. And you have to keep digging. There's no way two way about it. And this gets me to our next possible candidate for a Stan Weinstein play. Gild. I think it's Gilead Sciences on NASDAQ Stock Exchange. I have my 5 years data, weekly candles. I have my 30-week SMA. I have my volume. I have my RSI. Not the Mansfield, but it helps me know if I'm crossing over territory, if I'm bullish, if I'm going over the 50 line, if I'm going upwards or downwards. And I have the zigzag lines. As I mentioned in my previous podcast, Stan keeps mentioning corrections under 7% to ignore them for the trader, for moving your sell stops. And I just don't. It could fit maybe for a certain range of prices, but after that, some stocks either they're too volatile or they're not. I don't know if it's a function of their price, but sometimes it just doesn't fit. So I'm going to do it the old-fashioned way, move my sell stops when I have a sufficient correction, which I could visibly see if I'm comfortable moving it. I could always check to see if it's 7%, but there's probably a better indicator out there. I think on stageanalysis.net, they look at the ATR, the average true range. I'm going to have to practice a little bit that and see how that could be adapted to get some good moving sell stops and not get triggered out too early, which, like I said before, was my the first time I played Stan there in my early years. I used to get triggered out all the time too early. The move would go up, I'd get in perfect, had the volume, price would go up, and you see, I could probably call that an emotional landmine. And the price action was like up here after the 2008 crash, in May, June, and psychologically, did I move my sell stops too aggressively because I saw the price action was close to the top of my chart? But as someone mentioned, it's just if you just compress the view, price action is still the same, but psychologically, see, this looks like there's a lot of up room. And here, if I scoot it down, the inverse, look, that looks like a major top. So you got to be careful of that. And charts often, they put the highest values and then they try to make it fit, but the chart's not the end-all limitation of the price action. Zero is for stocks. Under zero, it's dead, bankrupt. But on the upside, who knows what the upside could be. Let the chart talk to you, the price action, and don't try to second guess it. And that's probably the number one emotional landmine traders fall onto without even realizing it. All right. Let's check it out. What do we have here? Nice stage 2. Stage 3. Stage 4. Stage 1. And possibly stage 2. So let's check that out. There's other questions I was asking myself about trend lines. Some people draw them from a tip high to high. I like drawing them candles, open or close of the candle. I believe that gives a better, a more real price action the close, better resistance, better support of that trend line if it's violated, especially on monthly candles, weekly to a lesser extent, but more so than daily candles. The wick, I consider that noise, and what really matters is the close. So all the rest is just noise. So if the market overreacted and you have a long wick, is the trend line really okay? Let's do this trend line this way, or is it this? See, they're very different. So, but the thing is with Stan's system, and I'm gonna have to figure a way to reason my way into it or find an alternative, is on the trendline violation. Traders they don't even tolerate any move. They take half of the position out. So let's say you played the down. Okay, right here. So this looked like this was the top of the formation right here. This was a breakdown candle. It looks even like maybe a head and shoulders, I guess. Left shoulder, head, right shoulder. Below the 30-week, I have to fix that pop-up here. I don't know. Sometimes it puts it over the price action. It's messy. And okay, right here. So this would have been investors maybe would have put their sell stop here. Traders 4 to 6% above the breakout line, above a round number. So let's say what's that? Broke down at a 97. 10% is 970. 5% is 435. So add that. So maybe at 101, 102. Maybe above these candles right here. There you go. That would have been maybe your sell stop. Would have entered here. And there's a classic pullback 1 to 3 months. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. A little bit more, almost 4 months. Crazy pullback. And you would have had another chance here to, it's above the 30-week moving average. So I'm not sure you would have entered there. But on the next candle going back down, you could have maybe entered. But let's say you would have been in here. Then you start writing it down. Then eventually there's going to be there might be a 3-point trend line right now. It could have been here. The trader, though, you would have been triggered out. Right here, half of your position. And with the 7% corrections or the corrections, moving your sell stop down. As a trader, you would have also been triggered out when you would have reached your sell stop. So maybe this is not the best example for the trendline violation, but okay, let me draw one. Maybe there was one here. So in function of where you would have drawn your trend line, let's say you have 1, 2, 3 points, and then you would have had some candles that would have had wicks go across the trend line, but close on the right, on the good side of the trend line for you to stay in the position. How do you deal with that? Do you sell? Or because you got to be careful, there's a weekly candle, so sometimes the wick starts going through the trend line and it could close really deep in, and then you should have sold. Like, so what's the how do you tolerate? Is the price, if the price, like any trade buy or sell with at a price on the other side of that breaks the trend line, do you get rid of half your position, or do you wait until the end of a daily candle, a weekly candle? Because I've seen often sometimes that okay, in this case, say here you would have sold at this candle here. Well, let's go with the 30-week moving average. A trader gets rid of the stock when the 30-week moving average is touched. Touch at this candle right here, this one here, but it closed above. So would you have sold with the price action within that wick, or do you keep it and then on the close of the next week that's really under, then say okay, this is a fail and you sell, you would have sold a little lower here. I've seen a lot of occasions that the wick goes through. It's just overreaction of the market. You get whipsawed out, or if that's the way, then you just do the stand way and just try to re-get in on the continuation buy. Like here, you would have been triggered out either by the trend line or by the 30-week move average violation. No problem, you're out. And after that, okay, the price action decides to continue back up, then you just re-enter on a continuation move. I have to clarify that. All right, where are we at today? Stage 2, stage 3, stage 4. All right, stage 1. Let's concentrate right now what we have. Let's zoom in. Oh, where's my volume? Okay, it was volume here, above the 30-week moving average, above a resistance line, horizontal resistance line. Investors, okay, 30-week moving average starting to go up. Look at that volume right here. Nice. How's the RSI going? Let's take a look at the RSI. Yeah, going up about, what's that, like 55, going up to 60. And right here, breakout candle. Entered right here. Investor sell stop at the bottom all the way down here. Traders 4 to 6% if below the 30 below the breakout line. So let's say 76, maybe 350. So 72 maybe. But you'd still want to be below a round number. 71. Could have cheated, put it here. Or I'd have to look at the stand book. You still protect yourself and you still put it under the 30-week moving average. I'm not, you see, I need to see more case figures to make sure I don't make those errors when it's go time, to make sure I'm the good path. Right now it's easy. I have hindsight 2020. I see a price action is there, so am I adapting the rules to fit the price action there? Those are considerations, because it does happen. If you're out, it doesn't matter much, because we do our position sizing from entry to sell stop. You just buy the size that equals. If you lose, you get triggered out here, you lose only 1% of your NAV. So it's not the end of the world. The important is to try to respect the protocol, the trading framework as it should be, without any emotion in it. And that's when you know you did a good trade. It's not if you reach a target or not. It's if you respected the protocol. You didn't step on landmines. You didn't sabotage it. You didn't get greedy, fearful. And if you keep repeating that over and over, you'll be good. And that's the hardest part. That's why trading to being proficient at it is extremely hard. All right. Either case, let's say you're an investor or trader, function of where you would have put it. Trader, maybe you would have been out, or even here, you had the violation of the 30-week moving average, you would have been out. But investor, you're in 1, 2, 3, 4, 5, 6, 7, 8. So you get that pullback. You get to add some more. Yeah, traders would have been out. Then price action goes back to previous highs. So you could, investors would probably bring their sell stop right under here. And here we are today. Is this the next pattern, the better launching pattern, the more powerful launching pattern for that stage 2? And if you're already in, maybe this is just a continuation pattern that you would need to add some more. I'm going to set my alerts. What we need right now is volume on a candle that would break out above that nice round number of 85. And the bearish scenario is a break below 71 or 72. But either case, so that would mean that this is stage 2 would be a continuation of stage 4. Look for volume twice the previous 4 or 5 week average, and we have nothing here yet. So right now it's stabilizing. The stock hasn't exploded as it maybe should have of this high volume. Maybe it wasn't sustained enough. It just needs a little bit more time to marinate. Didn't take off properly, but we might have a chance here once again. So keeping an eye on the GILD. It's still a strong candidate. The beginning of a stage 2, always fun. They're getting rarer and rarer, especially for NASDAQ stocks. And let's see if this one could gain some momentum and explode to the top side. All right, let's. I'll try to get some answers about those initial sell stops for traders, and I'll try to be more precise next session to make sure that I got that memorized in my subconscious. All right, man. See you all. Ciao.